Oh, hey, it's Donnie Loans. Hey, I'm reporting from Matty Loans. He's out this week with concrete shoes. You'll have to excuse him. I'll bring you the video this week. Don't worry, I got it covered. This week, in fact, I wanted to speak about mortgage hacks. I'm not talking about those hacks, guys, you need to avoid. I'm talking about those life hacks out there. And I wanted to see if there were any pertinent hacks to the loan business today. And honestly, I scoured very much the web. I couldn't find much. But thankfully, a viewer sent me an article I thought it would have legs, so I'm going to share. And with that, get rid of that funny accent. Now, the headline reads, Phoenix man got a 2.375 mortgage rate this year. He broke down how. Spoiler alert, this has to do with a mortgage assumption, and it's great clickbait because we've all heard how high the rates were during last year, and we've just become accustomed to the headlines of low inventory based on how many people have mortgages less than 5%, and the main reason why people are not selling. So back to this article by Business Insider, it mentions that rates have been on the rise, causing some people to pass on buying a home. Well, tell me something I don't know. But the moral of the story is this gentleman purchased a home. He got a below market rate, a 2.375 interest rate from an assumable loan. Now, the article's interesting because I've never known or read about somebody successfully completing one of these. I'm sure they're out there, and it's not to say they don't work, but I've been in the business for over 2 decades. I've never completed one myself. I've never even had a client request one. And I contribute that really based on the rate environment. Since I entered the business, it's been a slow, steady decline for really the last 25 years. I know the business and I just wouldn't know where to start with one of these. Anyhow, the guy explains the process, the difficulty he had with the request, and sounds very much like a regular loan process. But the moral of the story is you still have to qualify for the loan. He said it was an opportunity that worked out for him, but keep in mind he works as a realtor, so it's inside baseball. I don't think this would apply to the everyday buyer. And it goes into some of the details why. So it did work out for him, and it is a real experience, but let's contrast this with some of the other information floating on the web. And here's a great one from Forbes Advisor that explains exactly how assumptions work and provides examples of when it would work. Divorce, death, default. The author suggests that this trick may be underexplored, but I suggest it's underexplored for a reason. It's certainly a limited process, and I conclude this is more of an exception than an actual rule that you can use. See, death, divorce, default, but it outlines which loans are assumable, govy loans, of course, subject to approval, of course, and then it gets into the fact that it's available on conventional loans, not fixed, but on the adjustable rate mortgages, the ARMs. So the writer admits at the end it's not a game changer, but it is worth looking into. And it's funny that they brought up the ARMs because this got me curious to the figure on adjustable rate mortgages and which ones that you'd be eligible to leverage a discounted rate. And if we think about it really just in context of the pandemic, most ARMs are anywhere from maybe minimum 3 years to maximum of 10. And with those super low rates, how much of that applicable balance, the balance of the fixed term would apply? And interestingly enough, I found this article by the Financial Samurai that suggests the pool of outstanding ARMs are less than 5%, which I would agree. He comments that he thought it was closer to 25%, but since the great financial crisis of 2008, prior to that time, ARMs were probably more popular and prevalent, and they might have been as high as maybe 1 out of every 3 loans. The mindset since 2008, I think, of taking an ARM has waned because the opportunity of getting a fixed rate with a 2% handle during the pandemic, why would you risk taking anything else? And here's a chart between 2002 and 2008, and it does look like it climbed to as high as the mid 30 percentile. But banking on the balance of an ARM may not be the best philosophy because let's look at the big picture of interest rates, which shows the trend, not of mortgage rates here, but this is the 10-year yield. And since the 80s, it looks like this trend continually goes lower. The author points out, we are on the higher end of this range, but still within the trend, and suggests, he concludes, that rates should remain low for a while, which is one of the fundamental reasons why conventional loans are limited to ARMs is because of the Garn-St. Germain Act, which allows lenders this due on sale clause once the property changes hands. So it's just not an option out there for the majority of the conventional loans. But wait, what about the Govy options? Well, yes, that's available, but remember with FHA, there's certain requirements which include mortgage insurance that you're likely going to have to assume. And typically, FHA loans, they're great loans for the limited or low down payment. And with the recent increase, which is a substantial increase in the housing cost or the price of a home, assuming an FHA loan might be obsolete because you're going to be putting down a significant amount more than what that original owner did during COVID with maybe the limited 3.5% down payment. So it's going to limit you from the other options out there. And when we talk about the USDA, there's income limitations with VA loans. To keep that loan outstanding, it's going to restrict the entitlement of the owner. And then there's not the eligibility of the VA loan itself, but the buyer. And certainly that's going to be a limited pool who can even assume a VA loan. So rather than take you through all the pros and cons, because I think most of these are self-explanatory and obvious, I want to explain that this is not the cheat code and why you just might want to forget about it. So first, the unknowns. And I think there's just too many unknowns. And the only known that I can think of is that the loan has got to stay with the current lender or servicer. And I wonder what percentage of people know if their loan's assumable. And from the buyer's perspective, they're usually, if mortgage is a part of the financing contingency, you're starting with a pre-qualification likely from another lender and you're counting on that issuer of that approval letter to provide financing for your purchase. And who knows how long it takes to close one of these assumptions. In real estate, nobody wants to wait 6 months to close a deal. Time kills deals in real estate. And so anything outside of, maybe a quick close, I think is going to be really tough in this market, or really in any market. And last, what are the real costs? That is certainly an unknown. If we reference back to the BI article, it states that he had to pay cost of $30,000, but he accomplished this by waiving his $25,000 in commission. The article references the $385,000 sales price, and if $30,000 on $380,000, that's about 7% cost. Are you going to be able to outlive that in the next 36 months? Only time will tell, but again, it's another unknown and a significant one. Also, the engineering, or maybe reverse engineering. It's difficult to identify a property that's going to be eligible for an assumable loan. Perhaps this could be researched and put into the listing agreement, but are you buying a home based on your need for housing, a place to live, or are you trying to arrange this based on cheaper below market financing? To me, an assumable loan would just be the cherry on top. But if you were weeding out potential properties based on the assumable feature, it's certainly going to restrict your choices and an opportunity to make a deal work, even if you can identify one. So if you can reverse engineer one, great, but if not, it just might be left by the wayside. Also, interest rates. Remember the big picture and the 40-year trend based on that 10-year treasury note we visited. And we know that ARMs are less than 5% of the market out there. And to assume a loan where you may only get another 3 to 5 years left on the loan, it may not be that great of a deal. And there's so many other ways to finance a home. Limiting your choices, I don't think helps. A limited market for ARMs, the trend is your friend. I think it's highly overrated. Finally, the cost. And there's a significant factor for a higher down payment or to supplement that with gift funds or a second mortgage. Remember, prices are up 20 to 30% since the pandemic in most places, and that could make your required down payment or funding 20 to 40% based on today's prices. And to boot, if you need a second mortgage, remember those rates, if anyone that's explored secondary financing in the last 2 years, those rates today are anywhere between 8% and 10%. So even if you had a mortgage, let's just say that starts with a 3% that you could assume, but you need to get a secondary mortgage at a rate of 9%, you might have a blended rate closer to 6%, which really is not a whole lot off on where rates are today. So it appears complicated. It forces your hand into a higher opportunity cost, or perhaps closing cost, or both, which leads me to conclude assumable loans, it might be fugazi. Or
Better, because that's a fugazi. All right?
That's a fugazi? How do you know it's a fugazi? You looked at it for 2 seconds.
Well, it's a fake.
Yeah, I know what a fugazi is.